And we like that, especially in today's environment where, let's face it, the market has not been very cooperative, to say the least. So with that, I want to introduce Frank Lothar. Frank is a 24-year-old vet in the financial services industry. He's got numerous certifications, more than I can actually even count, in the area of financial advising, not only providing key subject matter expert advice in Social Security, but he also provides advice in regards to estate planning, taxation, retirement planning, trusts, etc. Very, very knowledgeable. Worked as a consultant, as a nuclear physicist. And a key point, which we had a little bit of a conversation before, he was also a participant and contestant on the show Jeopardy, which you don't come across those folks too often. So Frank, welcome to ICG Next. And thank you so much for taking time out of your busy life to educate our clients.
Mm-hmm. Thank you, Craig. And thank you, everyone, for joining us. So, yes, I agree entirely with what Craig was saying regarding Social Security, its importance, its significance, and the fact that most of us probably don't know as much about it as we probably should. Hence, today's seminar. This is to help get you a little bit more comfortable with what's going on this, and more specifically, what it means to you. So the core of this presentation, before we get into it, is really built around the idea of your decision-making process when it comes to Social Security. And there aren't many things that you can do in terms of Social Security that actually require you to make a decision. I mean, after all, you didn't really have a choice in participating in Social Security, did you? You didn't really have a choice in what level you participated in. It's not like your 401k at work, where you can choose to say, oh, well, I'm going to put in 7% a year, and next year I'm going to bump it up to 8%. You don't have that choice. And how it gets paid out on the back end, you don't have a choice of rolling it over, taking it as a lump sum, doing things like that. So it's going to be an income stream for your life once you actually activate it. So what is your decision-making process? Your decision is when to turn it on. And that's really what we're going to spend the bulk of our time on today, of setting up the elements of the conversation of how you get to that decision and what goes into making that decision. So I just kind of jumped ahead, and this is really what the first slide says. Choosing when to do it is going to be one of, if not the most significant single decisions that you're going to make in the process of setting up retirement income. And it's going to be guaranteed income for you, and if you're married, for your spouse, for life. And it's not just for life, it's also backed by the federal government, and it is inflation adjusted. So in terms of a core element of your retirement income strategy, Social Security really is it for the vast majority of people. But what we're going to talk about is just what it is, but also what it isn't. So let's give you an idea of some of the scale of this. So again, choosing when to start is what matters here, and again, income for you and for your spouse for life. So let's give you a sense of the scale of this. So if we have someone who's 62 years old and their full retirement age is 66 and 10 months, so that's somebody who's born in 1959, if they had a maximum earnings record under Social Security, meaning they paid in at the highest level possible to pay into it for 35 years, and the highest level in the current year is $147,000. Anything above that is not calculated into your Social Security benefit. So if you have somebody who is making that level of income for 35 years, then their total pool of money that they would receive from Social Security over the space of the following 20 years would be over $802,000. So let's put that in context. First off, can you afford to ignore $802,000 in your retirement? If you can, then you're paying for the next one of these seminars because you're in good shape. You don't need any of this. But most of us, $800,000, that's a lot of money. But let's put that again in context. Over the space of 20 years, that's about, round numbers, that's $40,000 a year. Okay, Again, a significant amount of money. But this is for somebody who was making $147,000 a year for 35 years. Is this going to be enough for them? No. It's going to be a good start, but it's not going to be enough for them. And that's really the key to Social Security when you think about it. It's important, and it's relatively inflexible, and it's very good, but it's not enough. But it's where you start. So, and again, keep in mind, we are talking about something that is automatically cost of living adjusted. Now, cost of living adjustments are something that for the last roughly 40 years, people haven't been paying much of attention to until now. Everybody started paying attention to cost of living recently, haven't they? So that's something that Social Security is going to take care of for you in a way that very few other alternatives that you have will do. So that in and of itself alone makes it a very important benefit to you. So let's talk about what we're going to go through today. So given the limits of time that we have, and honestly the fact that I'm not particularly that well versed in it, we're going to ignore the fourth section on this in Medicare. We're really not going to go there. We don't have time. So the three sections we are going to talk about is understanding your choices under Social Security, and that really is Social Security as a program, Social Security on a macro scale. Then we're going to talk about how to decide when to start. That's Social Security on a micro scale. What's in it for me? How does it impact my life? And then we'll talk about some strategies to help maximize your income using Social Security, which honestly have gotten a lot more boring since 2015, and the feds took the punch bowl away in a lot of these clever claiming strategies. But they can help illustrate exactly how the program functions and tie a whole lot of disparate elements of it together. So there's actually still some things to be seen there. So let's talk about your choices under Social Security. So first of all, you can, ignoring things like disability and unusual situations like that, just as a retirement income component, Social Security is something in general you can file for as early as age 62. That would be filing early, of course. You can file at your full retirement age, and the chart there shows you what full retirement age is based on your year of birth. So people born in 1954 or earlier, it was 66. It's slowly creeping up 2 months a year from there. And for people born in 1960 or later, its full retirement age is 67. Your benefit is calculated based on what it would be at your full retirement age. But if you delay beyond your full retirement age, up to age 70, you can have your benefit increase for the period of time that you delay. So which one is better? Well, whenever somebody asks you the question, which one is better, the answer is almost always, it depends. And a lot of what we're going to be talking about here is what does this depend on? So you start early, you can start on time, you can start late. You also need to pay attention to the spousal benefits and survivor income as well. Those are important components to it. And the saying at the bottom of the screen, the later you claim, the more you can receive. Doesn't mean the more you will receive, because we don't know how long you're going to live. If we knew the answer to that, financial planning would be a lot easier, wouldn't it? But we don't know that. We have to control for all of the possibilities there. So, if you file early, then you're going to get less. Right? Kind of duh, right? That's the way it goes. If you could file early and get the same amount, who wouldn't file early? Everybody would file early. As it is, about a third of the people file early. But they file as soon as they can at age 62. But as I mentioned, the full retirement age is slowly creeping up from 66 to 67. I mean, it started back at 65 back in the day, but that bumped up to 66 quite a few years ago, back in the 80s and 90s. And now it's slowly moving up to 67. But those brackets of the earliest retirement age of 62 and the ending of the accumulation factors at age 70, those aren't changing. So what changes based on your full retirement age is how much of a discount you take for filing early. So if your full retirement age was 66 and you filed at 62, you took a 25% haircut. If your full retirement age is 67 and you file at 62, you're going to be taking a 30% discount. So the bigger the gap between your full retirement age and age 62, the more of a discount you're going to be taking for filing at 62. Okay. So full retirement age, it's when you're expected to retire. there isn't that much to say about that. But it does give us the opportunity to talk a little bit about how that benefit is calculated. So your Social Security benefits are based on your highest 35 years of earnings that pay into Social Security. So this is something that's not well understood by a lot of people, particularly when they think of it in the context of an old-style pension from an employer, which was usually based on your average earnings in your last 3 years of employment. That's not how Social Security works. When it comes time for your benefit to be activated, the Social Security Administration will look through your entire earnings history under Social Security. They will inflation adjust all of those years, and then they will pull out the highest 35. They do not have to be continuous. They do not have to be last. They just have to be highest. And this particularly is misunderstood by people who may be thinking about going on to part-time before they fully retire, or doing a little bit of consulting work. And they think, oh, well, that means my income is going to be lower. That's going to drag down my Social Security benefit. No, it's not. More work can never decrease your Social Security benefit. It might not increase it. If you've already got 35 years of work history and that additional year is lower, then it's just not going to factor into it. It's not going to be one of your highest 35. So it didn't reduce it, but it didn't increase it either. If you don't have 35 years of work history yet, then by definition, any additional year is going to be included and will increase your benefit. So other than a short-term phenomenon we're going to get to shortly, continuing to work will not reduce your benefit. It just doesn't. That's not how the program is built. So if you are one of those few people who can actually exercise, deferral of gratification and wait to file for your benefit, delaying your benefit beyond your full retirement age, you will be getting an 8% simple interest increase for the period of time between your full retirement age and age 70. Now, just so you know, that is not actually calculated on an annual basis. That is calculated on a monthly basis. So for every month you wait, that is a 0.2% increase to your benefit. So if you start early, you get less. If you wait longer, you get more. So your trade-off is, I can get less for a longer period of time, or I can get more for a shorter period of time. So which one is better for you? Well, honestly, that depends on how long you're going to live, to put it simply. Now, one of the things, though, that does bias this discussion, and something that's not well understood about Social Security, is the system is designed to be actuarially neutral, which is a complex way of saying that if you live your single life expectancy no longer and no shorter, it doesn't matter when you file. The cumulative number of dollars you will get out of the system will be the same. But here's the punchline. Here's the thing that people don't understand. The formulas for this were built into the system in 1982 using the longevity expectations of 1982. Life expectancy has gotten significantly longer since then. So the system is built to think you're not going to live as long as on average people are today. So that biases the discussion in terms of mathematical advantage to delaying as long as possible. Now that said, if you're not necessarily in great health, then that doesn't apply to you. But just in the aggregate, average life expectancy today is longer than was built into the system. So that's an element that very few people are aware of. Okay, so let's talk about beyond just your benefit under Social Security based on your own work history. Let's talk about spousal benefits. Because you have to understand, this system was designed in the era of Ward and June Cleaver. It was built on the expectation that in a married couple, you had the husband who was in the workforce and he was out making a salary and he was paying into Social Security and he was racking up a Social Security benefit, and his wife was at home keeping the home, raising the kids, not getting paid a salary, and as such, Social Security didn't see anything from her. So the recognition was that her work had value and that she was entitled to some form of benefit on that, and the only thing they had to go on was his work history. So they said, well, we'll give her a benefit based on 50% of his full retirement age benefit. We are not going to get into a discussion today of the basis upon which somebody concluded that her work was worth half of what his is. We don't have time for that discussion because that'll go all day. It is what it is. You can consider it to be blatantly unfair, and I would not argue the point with you, but that's what the system is. So if you're talking about a situation where someone is filing for the spousal benefit, filing for a benefit based on their spouse's work history, they are eligible for up to 50% of that spouse's full retirement age benefit, but only once that spouse has actually filed for their benefit. So if I want to collect a spousal benefit based on my wife's work history, I have to be at least age 62, and she has to have actually filed for her benefit. Until she does, I can't get anything out of that, unless she is my ex-wife. So you can file for a benefit based on an ex-spouse as long as you were married for at least 10 years, you are currently unmarried, and you've been divorced for at least 2 years, and your spouse, your ex-spouse, is at least age 62. Whether they filed or not is not relevant. And probably a better idea that you're not reliant on determining what their status is under Social Security, because now you don't have to talk to them. That's probably healthier. So, and by the way, just a complete aside, never going to be relevant for anybody, but that issue of the married for at least 10 years, that is the one question I've ever gotten on Social Security that I can't even get a direct answer from the Social Security Administration on. And that is, for lack of a better term, the Elizabeth Taylor scenario. You're married to somebody for 7 years, you divorce them, and then in a fit of insanity, you remarry that same person. You're married to them for another 5 years, and then you wise up and you divorce them again. Are you eligible for this benefit at that point in time? And I can't get a conclusive determination out of the Social Security Administration, but I have read their operations manuals. And based on that, I would say you are, because it says married for at least 10 years and does not say anything about consecutive. But I've never run across a scenario that actually tested it. So it's all theoretical at this point. Okay. Now, in addition to spousal benefits, which is where you're tapping into your spouse's Social Security work history while they're still alive, there is also survivor benefits. So your spouse passes away. You have, in general, the option to, in effect, step into their shoes and take over their benefit. And when you think about what you would describe as a demographically stereotypical couple coming up on retirement at this point in time, husband and wife, likely as not, he made more money than she did. He's a couple years older than she is, and her life expectancy is longer than his. So based on that profile, what's the likelihood that a survivor benefit is going to come into play? It's almost a certainty. You certainly have to consider it because it's almost certainly going to come into play. And you are actually eligible for a survivor benefit earlier than you are just a retirement benefit or a spousal benefit. You can tap into that as early as age 50, or if you're disabled, 60 if you're not. And there will be a reduction factor for filing early, but it will be no more than 28.5%. And just another aside here, I've often wondered where it is that we get all these pictures that show up in these presentations. And I've come to the conclusion that somewhere out there is the Happy Old People Modeling Agency. And if there isn't one, I'm going to go start one because I'm going to make a whole lot of money just getting people's pictures in front of these presentations, because everybody out there in the retirement industry has all these pictures of happy old people. Got to come from somewhere. Okay, so that's Social Security on a broad macro scale. So let's talk about the decision-making process. How do you figure out when it makes sense for you to file for your benefits? So there are really 5 major considerations here, and some are more important than others. But the ones we're going to look at is how much your benefit is, how long it's going to last, if you're still working, what does your tax profile look like, and the impact of survivor benefits. So these are the important ones. So how much is your benefit going to be? I mean, if your benefit's going to be $4.18 a month, who cares? It's not relevant to your planning. So until you know the level of your benefit, that's what's going to be your starting point, because now you're going to say, okay, I have this already pinned down. What do I need beyond that? Well, you don't know what you need beyond that until you know where your starting point is. And the best place that you're going to have for this is the Social Security Administration. You can probably remember up until really the financial crisis, every year around your birthday, you used to get a statement from Social Security in the mail. It's 3 pages long, ugly green color scheme, and it'd tell you what your benefit would be at age 62, at full retirement age 70, had the long litany of what your work history was under Social Security on page 3. And then they stopped sending those out due to just budget cuts and the financial crisis. They've actually restarted sending those, but they only do it on a rolling 5-year basis now. And they won't do it at all if you've registered for an account on the Social Security Administration's website, which honestly I would suggest most people do, because it's going to be the most current access to information you have about your Social Security benefits. And you can go in, and once you've registered, you can get them to produce a PDF version of that statement on demand anytime you want it. And it's going to show exactly the same information. And it is a projection, it is an estimate, and they disclose that, because if you're not age 62 yet, how do they know what your benefit is going to be at 62? Do they have a magic crystal ball to know how much you're going to pay into Social Security between now and then? Of course they don't. So what they do is they build in these assumptions, and they disclose those. And they say, we assume that you are going to continue earning money at exactly the same level as the last year we have on file, right up until the moment when you file for your benefits. It's a reasonable assumption. They don't really have anything else to go on, but it's almost certainly not going to be exactly true. But as a basic starting number to get a ballpark of what your benefit is going to be, there really isn't anything better. Okay. So considering how long your retirement will last, this, by the way, is a polite way of saying, when will you die? And that's how long your retirement lasts, doesn't it? It starts when you retire and it ends when you pass away. So how long will your retirement last? How long are you going to live? And so your longevity pays into this, and I kind of referred to that earlier in the actuarially neutral assumptions built into it. But the bottom line is that if you are expecting to live longer than average, then delay is generally mathematically to your advantage. So if all of your grandparents lived into their 90s, then your longevity expectation is a little bit higher than average. It would mathematically make sense for you to delay. But there's an additional consideration, which is simply put, need. If you need the money earlier and you're not going to be comfortable in your retirement earlier, then you may just have to go ahead and pull the trigger and file for the benefit early. So those, to me, are really the 2 most important elements in determining when you file for your Social Security benefits: longevity and need. And they may counterbalance each other, they may reinforce each other. Depends on your particular set of circumstances. Okay. Now, if you are going to, if you have somebody who's coming up on age 62, and they're thinking, oh, I'm going to become eligible for my Social Security benefit, but they're still working. They could potentially file for their benefit, but it's probably not going to do them any good. The way the program is set up is to say, we do allow you to file for your benefit earlier than your full retirement age. But that is based on the assumption that you are doing so because you are no longer working. That you can file early because you've retired early, not just you're filing early because you want to. So the system is designed to say, if you file for your benefit prior to the year in which you turn your full retirement age, and you still have wage income, this is purely about wage income, income from work. This is not looking at investment income. This is not looking at drawing down your IRAs. This isn't looking at the rental income you're getting from your vacation house, anything like that. This is strictly wage income. So in the years before you reach your full retirement age, for every $2 you earn above the current threshold is $19,560. And that really isn't very much money, is it? So for every $2 you earn above that, they will withhold $1 of your benefits. So if you've got a 62-year-old who's making $75K, don't bother. They're going to withhold the whole thing. There is no point to going ahead and filing at that point in time. So they set the threshold above zero for the possibility that you're going to have a hobby job or you're going to do a little consulting on the side. They're not worried about that. But if you're making above this, essentially you're still working. That's not what this program is designed for. So once you reach your full retirement age, this no longer applies. You can make as much as you want to once you reach your full retirement age, and you will still be receiving your full Social Security benefit if you file for it. They are not penalizing work in retirement. They are essentially discouraging filing early when you are still working. Couple of things to know on this, however. First off, I referred to this as a withholding, and it is. Because if you are ever subject to this limitation, once you reach your full retirement age and it no longer applies, they will take the entire pool of money that was withheld from you, they will amortize it over your life expectancy, and they will raise your benefit by that amount. So you haven't lost it, you've merely delayed it. The other thing to be aware of here is this threshold applies on a per taxpayer basis, not on a per filing basis. So if, for example, you have a married couple and they're both age 62 and one of them is still working and the other one isn't, then the one who isn't working can go ahead and file for their benefit and not have this test apply to them, even if their spouse is making $100K a year. Because it's based only on the income, the wage income for the person who would be collecting the benefit, not for the collective unit of the married filing jointly status. One of the few times when married filing jointly status actually looks through to the individual rather than the aggregate. But it does here for these purposes. Okay. Now, in addition to that particular component, now we also do have to look at the question of taxation, because Social Security benefits are potentially subject to taxation in retirement. So depending on an income threshold for a concept called provisional income, which we'll get to in a moment, if you have income above certain levels, then a percentage of your Social Security benefit can be included in your adjusted gross income. So for the sake of clarity and just to streamline this, we're going to look at married couples, married filing jointly status. So if your provisional income is below $32,000, then your Social Security benefits are not subject to federal income taxation. If you're between $32,000 and $44,000, then up to 50% of your benefit is includable in your adjusted gross income. It doesn't mean you're in a 50% tax bracket. It just means up to 50% of your benefit can be included in your taxable income for the year. If your provisional income is above $44,000, then up to 85% of your benefit can be included in your adjusted gross income. So if you're going to be an optimist about this, and nobody is ever an optimist when it comes to taxes, at least 15% of your Social Security benefit will never be subject to federal income tax. Nobody ever looks at it that way, though. Now, the important thing to know here, though, is that the definition that we use for these thresholds, provisional income, is a definition that's only ever used in the tax code here. Provisional income is a very inclusive definition of income. The last slide, we were talking about a very exclusive definition of income. This is a very inclusive definition. And so what goes into provisional income is your normal adjusted gross income, that bottom line on your 1040 form, plus any tax-exempt interest income you have. So if you've ever seen those commercials on CNBC or Fox News or Business Channel or Bloomberg in the morning, and they talk about build a tax-free income retirement stream from using muni bonds. You've all seen those commercials. They are talking about something that it's not directly subject to federal income tax. But what they are not saying is that income that you're getting from those muni bonds is included in provisional income and might be forcing up the taxation of your Social Security benefits. So there is kind of backdoor stealth tax on muni bond income through Social Security. The other thing to know on this is these thresholds are very odd for the tax code. They're round numbers. You never see round numbers in the tax code. And the reason you never see round numbers in the tax code is because everything is inflation adjusted every year. These aren't. These thresholds have not changed since the 1980s. So effectively, this is a tax increase every year without actually representing it as such, because every year it's creeping up on more and more people just by the actions of inflation. But those thresholds haven't changed in 40 years. Okay. Well, let's move on and talk about survivor benefits. Kind of touched on these a couple of times before. And given the demographic nature of most couples today, the likelihood that survivor benefits are going to come into play is very high. But I also want to kind of bring the whole package together here for a moment, because I've talked about actuarial neutrality. I've talked about life expectancy, and women live longer than men, and it's patently unfair, but we're stuck with it. And the actuarial neutrality being based on 1982 life expectancy factors. So the actuarial neutrality is built on a single life. But if you look at a Social Security benefit for the higher earner of the couple being effectively a joint life annuity, it's not paying out for one lifetime, it's paying out for two. And that's longer than one on the average. Include with that the fact that the life expectancy factors being used are assumptions from 40 years ago. Now what it's saying is that when you're dealing with a married couple, the likelihood that delaying the higher earner's benefit to maximize it and delay it until age 70 mathematically is almost certainly going to be to your advantage in almost any scenario other than significantly impaired life expectancy. So Social Security optimization strategy is always built on that core principle, which is delay the higher earners until age 70 because it's a joint life annuity. Okay, so now we're going to get to some of those strategies just for a couple minutes here and kind of pull everything together here. So the Bipartisan Budget Act of 2015 reined a few of these in, and it was just it was a revenue-raising measure, nothing else. It didn't really do much else to Social Security. You may have heard of the old concept of file and suspend. That's long gone now. 2016, that was gone. We're not even going to talk about that. But there is a concept of what's known as a restricted application, which still exists today, but the window on this one is closing. So what a restricted application was historically was to say, if you had somebody who was of full retirement age, and they were eligible for two benefits. They were eligible for the benefit based on their own work history, and they were eligible for a spousal benefit based on their spouse's work history. They were allowed to elect a restricted application, meaning I'm going to say, I don't want my benefit. I'm restricting my application to just the spousal benefit based on my spouse's work history. And that way I'm not filing for my own benefit. My own benefit continues to accrue until age 70. Well, what the Bipartisan Budget Act of 2015 did was it said, we're going to put a sunset date on this. If you were born in 1954 or later, you don't get to do this anymore. If you file for your own benefit, you are deemed to file for the spousal benefit and vice versa, and you automatically get the higher of the two. They call it a deemed filing. So if you have somebody who was born before 1954 and still hasn't filed for their benefit yet, they could still take advantage of this. There aren't that many people in that category. They're 68 years old at this point. So not very many people in that category, but we're going to run through a scenario that applies to this just to kind of tie a bunch of concepts in the program together. So this is what used to be known as the start now and get more later, or the phase-in strategy. And I don't find this screen to be terribly useful. We're going to jump through to the next one, which kind of illustrates the point. So what we have in this scenario is Fred and Jane. You can call them Fred and Ginger if you want to. Call them Fred and Wilma if you want to. Call them Fred and Barney if you want to. I don't care. Doesn't matter. So the point is, we're going to wind the clock back in time a little bit. These are people who were eligible to elect the restricted application. So they were born in 1954 or earlier, and their full retirement age is 66. So we're going to make the blatantly sexist assumption here that Fred's full retirement age benefit is $2,400 and Jane's full retirement age benefit is $1,000. So we're going to say at age 62, Jane is no longer working. And so Jane is going to go ahead and file for her benefit. And so her benefit, because she's filing early, is going to be reduced. So instead of that $1,000 a month that she was getting, that she would be entitled to at her full retirement age, she's getting $750 because the discount factor is 25% for someone whose full retirement age is 66 filing at 62. So she gets $750 a month. Okay. And whether Fred is working or not doesn't matter because the earned income test is applied based only on her for the purposes of this, and we're going to assume that she's not working. So she collects her $750 a month until we reach age 66. Now at age 66, Fred is going to do something a little bit clever. And this is the cleverness that the Bipartisan Budget Act kind of took away. And he says, well, I've got my own benefit. It's worth $2,400 a month. But I don't want that because I want my benefit to continue to accrue. So what I'm going to do is I'm going to file a restricted application. And I'm going to say, I just want the spousal benefit. So Jane has already filed for her benefit, so he's entitled to the spousal benefit. And that spousal benefit is based on 50% of the other spouse's full retirement age benefit. So we're not looking at half of $750. We're looking at half of $1,000. So Fred gets $500 a month out of this, not $375. So now between the two of them, they're getting $1,250 a month. And whether Fred is working or not isn't really relevant directly because he's at full retirement age and the earned income test no longer applies. So now we're going to fast forward the clock again, and we're going to go to age 70. The 8% accumulation that has been running on Fred's benefit all this time now reaches its end. So he could delay beyond this if he wanted to, but there's no mathematical reason to do so. So he says, okay, I'm done with the $500 a month I was getting from as a spousal benefit based on Jane. I'm going to flip over to my own benefit. So his $2,400 a month has now grown just through the 8% delayed credits. We're not looking at further work history from him. We're not looking at cost of living adjustment. We're just saying that 8% a year, simple interest, has grown his benefit from $2,400 to $3,168. That's kind of nice, isn't it? That's a significantly greater amount of money, but he's collecting it for a shorter period of time. So now that he has turned on his benefit, now for the first time, Jane becomes eligible for a spousal benefit based on Fred's work history. She has not been eligible for this up until now because he had not filed for his benefit. So now she is entitled to a benefit based on 50% of his full retirement age benefit, which means she is not looking at half of $3,168, unfortunately. She's looking at half of $2,400. Now, the slide here says, Jane elects spousal benefits to generate more income of $950 a month. Where the bleep did we get $950 a month from? Where we got it from is she filed for her benefit early, and she took that 25% discount. And that discount, not as a percentage, but a dollar amount, follows her forward. And so when she files for the spousal benefit, she will get the $1,200, which is half of Fred's $2,400 full retirement age benefit, minus the dollar amount of the discount she took. So $1,200 minus $250, that's where we got $950 from. And now they sail off into the sunset. But I'm going to take it one step further than the slide actually goes. What happens some years down the line when Fred passes away? Well, when Fred passes away, Jane will have the opportunity to step into his shoes. And she will stop collecting the $950, and she will take over the $3,168 he was getting. But importantly, in this scenario, it's not $3,168 minus $250, it's $3,168. That discount she took for filing early goes away. She now gets what he was getting, and that's hers for the rest of her life. Okay, so you can see, even if this doesn't apply to anybody in the audience here, in statistical probability, that's pretty low that it does. A whole lot of different concepts involved in this program all get pulled into one package here. That's why I keep the slide in, and I probably will even after it no longer applies, theoretically, in 2 years. Okay. So there is one other scenario we have here, and we're just going to kind of quickly go through this one. And this is for someone who is a relatively early widow or widower. Not applicable to very many people. So what this is saying is we have Bob and Cindy. Bob and Cindy look an awful lot like Fred and Jane, except they were born a couple of years later, and Cindy unfortunately died early. So Bob has the potential to file for a survivor benefit as early as age 60 based on Cindy's work history. Continue to collect that until such time as he files for his own benefit. And so he can wait until 70 to file for his own benefit and get his full benefit with the 8% delayed credits, but still be collecting money for the 10 years in between. But keep in mind, for the period of time between age 60 and his full retirement age, which is 66 and 10 months, he is subject to the earned income test. So this really only has value to him, really, if he's not working starting at age 60. Okay, so just to put it in simple context as possible, Social Security is the cornerstone of most people's retirement income strategy. It's something that's there for you. You don't really have any choice in it. Your only choice is when you file for it. It's going to be inflation-adjusted, lifetime income backed by the federal government, but it's probably not going to be enough. So it's the cornerstone upon which you build out for your retirement income plan.